I'm talking to Jeff Fulcher today from Velocity Bank. He's the Senior VP at Velocity SBA, a nationwide PLP lender. I've worked with Jeff on many FedEx deals over the years. Today, this is for FedEx owners who are thinking about selling now or in the future. If you want to get the best price for your routes, selling routes for all cash versus having an SBA-backed loan can make the difference in several $100,000 for an owner. So, Jeff, thanks for being on with us today. I wanted to start out with, at a high level, what makes a FedEx business SBA eligible versus non-eligible?
Yeah, sure. And thanks again for having me. Appreciate you giving me the time. Yeah, so what makes it eligible, I think there's just probably two or three really easy key points, right? So every FedEx route, as you know, they're entitled to a certain zip code. So they operate as an independent contractor. So that's step number one. Step number two, which by the way, I think is the most critical piece, it's the contracts in which FedEx provides to the independent contractors. Since those contracts are transferable, and when we have a buyer coming in, they will then allow that contract to be transferred to the buyer. That is what essentially makes it eligible. So it's obviously operating for profit, which is one of the key requirements. It can't be nonprofit. Also, the fact that it's an independent contractor style of operating, and then having the contracts being transferable. I think those are the three elements that ultimately make it eligible and do make it eligible through the SBA.
Great. So, Jeff, what are the most common SBA issues that you specifically see with FedEx routes when you're approving a loan?
Sure. I want to say just high level, you've done this a long time. A lot of lenders kind of shy away from FedEx routes. I just want to say, and it's simply because of the contracts, right? So I would say, are a handful of lenders that actually have zero implications, and we don't have any heartburn given that it's a 1-year contract on the renewal side. So I think that's probably one of the bigger challenges you may see from other lenders. Obviously, me and you have closed a handful of these, so we don't have that issue. And I would say the other common issue is we try to have some sort of experience, right? So I think that's a big thing nationwide. Any lender you ask, doesn't matter what the type of business is, we want to be able to apply some type of experience to whatever the businesses they're buying. So in the FedEx route, I think that's one of the challenges. Now, we are able to overcome this challenge if they have any type of experience, whether it's managing people, managing a team. At the end of the day, that's probably the biggest issue. And then obviously cash flow and how sellers are ultimately reporting their income is going to be a typical challenge that you'll see in FedEx routes, just depending on what type of add backs we're actually able to account for and justify.
I'm glad you're talking about experience, because from a buyer standpoint, I do see a lot of buyers that some have FedEx experience or driving experience.
Yep.
Others are from the tech world. So can you talk a little bit more specifically about the best fit for a FedEx route?
Yeah. I mean, obviously, best fit is going to be somebody like you mentioned. Either they've been a driver, have their CDL license, or somehow they are already, a FedEx operator, which again, as me and you both know, that doesn't happen very frequently, right? We don't really get to see people that have managed a logistics company or driven a truck. So typically, if I'm just going to be candid, we're always looking for mitigants, right? An SBA deal is never right up the middle. So we as the bank, we obviously weigh the pros and the cons, right? And if we have good cash flow, we have a good business, and we have a strong operator, meaning our borrower, what do they have that can kind of mitigate the direct risk, which is, do they have a spouse that has outside income? Are they also having a job that maybe they're allowed to keep and work remote? So now we have some additional income coming in. And then of course, one of the biggest components is going to be, do they have a house or collateral that they're going to be able to pledge, right? Because at the end of the day, these borrowers are coming in with 10%. We are taking on the boatload of the risk. We're financing 90%. So when we're denying a deal, or we're having heartburn about a deal that has lack of experience, it's really our job to try to find out what other mitigants there are to make us feel good about doing a deal like that. And honestly, even if they're just an entrepreneurial by trade and not in logistics, that helps. But the ones like you mentioned coming from like corporate America, those are the ones where we really need some type of outside support, whether it's collateral or outside income from a spouse, or for them to, keep their current job and work remote. So I hope that answers your question.
That's perfect. Then when you review the P&Ls, the financials, what are the things that you look for in the financials? Talk a little bit about that.
I think, listen, a FedEx route is very simple, right? I mean, at the end of the day, you're going to have your revenue. Most of it's going to be the cost of the trucks and then labor. I mean, obviously there's some other mundane expenses that get built into that, but you got repairs, you got labor, and then obviously you have the trucks that are going to be the bulk of your expenses. So pretty much two or three things that we're going to look at. The number one is going to be revenue. Obviously, when we look at revenue, it's not too important what the actual revenue is. It's important what the trends are, right? So if you went from $1 million in revenue in 23 and now you're down at 900,000 in 24, 800,000 in 25, you're obviously on a downward trend. That's not something we like, and we're going to have to account for that. Obviously, upward trends or flat trends, that's fine. So when it comes to revenue, that's really all I'm looking at, is just what the trends are. And then I would say the same about cost of goods or just overall expenses. They're more just going to be in relation to what the trends are. Are the costs of goods and the expenses going up, down, or are they staying flat, right? And then ultimately all that ties into EBITDA, or what, in your world, you call it seller's discretionary earnings.
Yeah.
So we just want to see what that SDE is looking like over the last 3 years. Are we going up? Are we going down? Are we looking flat? And obviously, if we're going down, there's always going to be a story behind it. And so that's what I think I'm good at my job for, is kind of uncovering, maybe there was just an arbitrary thing that occurred in 24 and 25 that would not happen in 26, 27. And just uncovering those things and explaining that to credit is typically how we get over some of those hurdles.
One of the things that I run into, a typical example will be there are FedEx routes, the sales are 1.7 and the offer, let's say, is for 1.5.
Okay.
And their seller discretionary earnings are around 400,000. So explain to me, there's this thing called debt service coverage ratio that I explain to buyers, but can you explain what that means in layman's terms to sellers and how they can figure that out on their calculator?
Sure. Going to try to break it down real simple. Antoinette's probably heard me do this on the phone with her like a million times, but I do have a little mortgage calculator. I also obviously have a spreadsheet, but it's always easier for me to use my calculator. But what I would do is I would just take a $1.5 million purchase price, and I'm going to multiply that by 90%. 90% because I'm financing 90% of the acquisition costs, right? So if they're buying it for 1.5, they're coming in with 10, I'm financing 90%. Again, this is very high level. We build in working capital, we do other things, but I'm just keeping this super high level. So I'll multiply that by 0.9. You'll get 1.35. Okay. So what I'll do is I'll say that's the loan amount. It's going to be a 10-year loan, and we'll just call it 9% interest. Okay. That gives you a payment of 17,000. I don't know if people can see that. It might be backwards, but 17,000 is going to be your principal and interest payment per month. Okay. So in order to calculate a debt service coverage ratio, what you need to do is annualize that payment out, right? So I'll take the 17,101 times 12, which gives you 205,000. Okay, $205,214. That is what you're paying the bank on an annual basis with your loan amount, right? So in order to calculate a 1.25 debt service, I'll just take that annual P&I payment and multiply it by 1.25, right? So that's 256,000. And I think just really quick for anyone that's kind of a numbers person, take out your exact example. Just assume that your P&I payment to me for the year is 100,000. Right. So when it all said and done, you owe me 100,000 at the end of the year, then your cash flow or your SDE would need to be 125,000, which would equal 1.25 debt service on a $100,000 annual loan. So I hope that explains it. It's obviously second nature to me, but I'm trying to dumb it down.
That does. And do you account for the owner's salary in there?
Of course. Yeah. So owner salary, is obviously, if the owner's not taking a salary, then that number would just fall to the bottom line, right? So an owner's salary is obviously going to be an add back. And I don't want to steal the show here, but I think it's really important for anyone that's watching this, especially you gave an example about people coming from corporate America. What a lot of people just seem to forget is if they are foregoing their income, right? So let's just say you're a single guy looking to buy a FedEx route and you're making $300,000 a year at your current job. Now you want to buy a FedEx route, but you're not going to have any employment except for the FedEx route. People really need to understand that now I'm underwriting this deal not only for the FedEx route, but we also have to incorporate all of their personal obligations, right? Because we're not just going to do a deal knowing that it can just pay for the business that you're buying, but now that this business is your sole source of income, it also needs to pay for your mortgage, your car payment, your student loans, whatever else it is that you have as a personal obligation. Since there's no other income coming in, it has to account for that. And so oftentimes we'll see a deal that looks good if you're just looking at the business as a standalone business, but when you bring in a buyer that has additional obligations like we all do, but no other way to pay those obligations, but the subject business, that can really hurt cash flow on a deal. So I just think that's really important for people that, may be watching this, because I see it all the time.
That's interesting. So you may have a FedEx deal that qualifies for an SBA-backed loan, but then actually finding the buyer that's going to qualify as well is another factor that's super important.
Oh, of course. Yeah. I mean, I can pre-qualify FedEx routes all day long, right? Like, yes, it stands alone by itself. It's at a 125 or higher debt service, but then obviously you bring in a buyer and they don't have any other source of income. And it doesn't take much for that debt service to get, reduced if they have a mortgage or a car payment. So that is something that's definitely important to keep in mind.
If you're a business owner and selling is even a possibility someday, start preparing now. On this channel, I share real strategies, real numbers, and weekly insights to help you sell smarter and maximize value. Subscribe and stay ahead. So Jeff, what about how do aggressive add backs or overly adjusted expenses affect underwriting?
Yeah, good question. I mean, listen, I think sometimes people stretch in terms of, at the end of the day, I think there's two ways to look at a deal. I think a potential buyer can look at a ton of sellers' discretionary earnings and just kind of keep it in their back pocket. Like, okay, maybe they paid $6,000 for, I don't know, groceries, but they wrote it off through the business, right? Like,
Yeah.
as long as that can be proven to the buyer, that's fine on their end. But as a lender, we're not really here to nickel and dime a lot of those smaller expenses, right? At the end of the day, we're really only going to be looking at some of your major add backs. So obviously, interest, depreciation, owner's comp. Now, listen, oftentimes, Antoinette, we've seen deals where people expense rent, right? Maybe they're writing off a home office for the business when we all know that there is no rent expense incurred for a FedEx route, right? FedEx handles that rent. And
Yeah.
I've seen those on some of your transactions as high as 60, 70,000. We're going to add that back all day long, because it's an extremely nominal amount, 60 to
Mhm.
70,000. We've also seen personal vehicles that are ran through on a FedEx route. We'll add those back too. But what we're really not trying to do, I think, to answer your question, is do a bunch of $2,000, $3,000, $4,000 add backs just to get us to that 1.25. Like if we have to, crawl and scratch just to get us to that point by adding back $2,000 here, $4,000 here, I just don't think it's something that many lenders are interested in because we really do have to verify all those add backs, right? So there's a lot of document intensive things that are required with that. So I would keep it very high level and just make it make sense. But if you have any like specifics that you want to ask, I'm happy to answer.
Can you sum up? So it's cash flow, and what would you add to cash flow? Amortization,
Yeah,
depreciation,
sure.
interest, and you just said W-2 salary. What is
Yep.
FedEx?
Yep. So, simple cash flow, you have your revenue minus cost of goods gives you your gross profit. Then you're going to have your remaining operating expenses. And then when you subtract that from the gross profit, you have your net income. So that's kind of our baseline. You have your net income. And then I kind of look up on the front of the tax return. So you have your net income, you're going to be adding back interest and depreciation, right? So that's your standard. And you have amortization because a lot of these FedEx routes, they're being sold within 3 to 5 years. So they're still expensing their amortization from when they
Yeah.
purchased the route. So you have your net income plus depreciation plus amortization plus interest. That right there is what we call EBITDA. So that's kind of your standard. Now, quite a few add backs that we look at is obviously the owner salary.
Mhm.
Oftentimes we'll see owners that pay maybe their wife or their daughter or somebody in the family. That's also going to be considered an add back. We will add back personal cars, right? So if you have $1,000 or $1,200 a month lease for like a Tesla, and we all know Teslas aren't required for the FedEx business, I would
Yeah.
add stuff like that back. And I've even seen, I'm okay if you have a large family and the owner's paying health insurance, right? Because health insurance can be pricey. So if you're seeing like a $15,000 to $20,000 a year premium for health insurance, but we have a buyer coming in who's maybe their spouse is able to provide health insurance through their W-2 job, that's obviously not going to be an expense that's going to be incurred by your buyer. So I'd say I think those are pretty solid add backs. I think one that me and you discuss a lot, and it's a gray area. So I don't want to sit here and say that it's eligible in every deal, but sometimes they're overstaffed, right? When we're talking
Yeah.
about, BCs and things of that nature. So, if they have 3 BCs that are on staff, in theory, you really only need 1 BC, and then you'll have obviously your buyer coming in. So you have 2 potential salaries that we would like to take a look at potentially adding back. And we just have to justify it. And a lot of that comes down to the experience of the buyer. How much help do they need when they buy this? But I think those would be probably the only add backs that I'm really interested in considering on a FedEx deal.
Yeah, I'm glad you brought that up because some FedEx routes do need the 1 BC, but the larger ones may require a couple more.
Sure.
But we have to be really careful in showing you the W-2s and justifying that over a period of time. So
Yep.
let's talk about the fleet. So we see a lot of routes where they've got a mix of fleet, so older, newer, some are really old. And how do you evaluate that in an acquisition?
Yeah. So, wow, this is a fully loaded question. I really don't even know where to start. But obviously, you have the trucks and you have the goodwill. I don't want to get into it from the bank standpoint, but a lot of times, let's just use $1 million acquisition. Maybe the business is being sold for 7, the trucks are worth 3, right? So,
Mhm.
yes, we're going to get an equipment list, and oftentimes a lot of those trucks are going to have 10 plus years worth of mileage on them. So yeah, we take that in consideration. We call that CapEx. What we really don't want, and anybody should not want this, when you step in to buy a FedEx route within the first 30 to 60 days, you have to replace a transmission or completely buy a new truck, right? And so I think you've actually done a really good job on this. I think it's important. And we actually, believe it or not, my president has weighed heavily on this on some of your deals, is you put a clause in there for your buyers where they have a inspection period, typically for, a due diligence period
Yeah.
to look and have their trucks inspected. And then the seller is responsible for any major repairs. I think that's actually golden. I don't think there's enough brokers out there doing that because at the end of the day, it's only fair, right? If there's a ruined transmission under a truck that's going to cost 20 or 30,000, that's not being reflected in the purchase price, then the seller should cover that. So I think that's critical. I will say that we're one of the few lenders that will aggressively add working capital in there, specifically if there are some older trucks. So depending on the size of the deal, depending on how many trucks there are, I'd say we're going to always be anywhere between 50 to 100,000 in working capital. And that's really primarily all going towards the trucks, right? Like we just want there to be a nest egg for our buyers in case, God forbid, you have a major expense or a major repair that comes due within the first
Yeah.
90 days, that you have that money sitting there and waiting for you if you need to make those repairs.
Jeff,
So.
is that working capital based on percentage, or how do you guys figure that out?
Rule of thumb is we call it general and admin expenses, but in this case, every industry is different. But I think with FedEx routes, there's going to be one main expense that we would look at working capital for, which is labor, right? So that's a big one for any business that we're financing, right? So you're stepping in day one, but you have payroll due day one, right? And so
Yeah.
we want there to be a little bit of a gap, and we want to kind of bridge
Yeah.
that gap. So if you have, let's say, $100,000 a month in payroll, we're probably going to be inclined to want to give you at least $100,000 in working capital, because what we don't want you doing is going in there, giving away every dollar you earn back into the labor force or back into your cost of goods and your operating expenses. So we typically like to give 1 to 2 months of labor or operating expenses. Now that can get a little skewed as you start to do larger deals and do things of that nature, because FedEx, the operator is going to be making money every day. So it's not like they're looking at receivables, which that's kind of where some of these other businesses where maybe they're looking at like a net 30 or a net 60 to get their money. FedEx, the day they take over, their cash register is already ringing. But we just like to give them that cushion, because at the end of the day, if they don't make a payment to us, we're failing. So what is it to give them? I would say typically 10% of the loan amount is something that I like to see, and working capital is kind of where I like to draw the line. I don't think there's a golden rule as to how much, or, usually we actually leave it up to the buyer. Like he or she needs to come to me and say what they need in working capital. It's not really my job to tell them how much they need. They have to sell me on why they need it and how much they need. And I'm never going to push back on it. I'm always going to present it as such. And if we scale that back a little bit, so be it. But, I always encourage to ask for as much as possible and let credit bring that number down. So
that working capital is a combination. It's used for first month, and it could be used for CapEx.
Oh, for sure. Yeah,
Yeah.
absolutely. Yep.
Interesting. Now, in terms of the requirements from a buyer, what are you all requiring the buyer put down in an SBA loan for FedEx?
Great question. And I don't want to put my foot in my mouth here, but I think on these smaller transactions, when I say smaller, I want to say like 1.5 and under, specifically under $1 million, we will entertain 5% down with a seller carry. But I think really a good structure on any deal, some people just like to get creative with the financing. I think the best structure that anybody could ever put together is just 10% down from a buyer, and then get some form of a seller carry, whether that's 5 or 10%. And it's not really so we're lending less. We just like that the seller has some skin in the game as well, especially if they've owned the routes for 3 years and now they're already selling it. The question's always like, well, why are you selling it? Well, then you wouldn't mind just putting up, a 5 or 10% seller carry, because there's nothing to worry about, because the business is still, obviously you expect it to be doing good. So perfect scenario, 10% from the buyer, 5% seller carry is golden, I think, on any deal that we ever look at.
Jeff, what about deal killers? So let's say that you approve an SBA deal for FedEx, and then you have the buyer, you're going through due diligence. Have you seen any deal killers? Talk about this.
Ooh. And you're talking about on the buyer's side, right?
And it can be on the seller side as well. What can cause a deal to blow up financially for the bank?
Man, lots of stuff. Well, let's just start on the buyer side. I think in the banking industry, everything's about integrity, right? So we're going to ask you questions, especially on the loan app. Have you ever filed bankruptcy? Have you done, just standard questions? And a lot of these credit issues, we're actually able to get comfortable with, but we're a big character type lender. So if you've been asked 3 different ways on our loan app and all these other questions, have you ever filed bankruptcy, even if it was 15 years ago, but you keep putting no, I've seen it happen a million times. If you had just put yes and addressed it and we asked the question, okay, but since you decided to we see it as you're hiding something. You put no, we asked you 3 different ways. I don't care if it was 20 years ago or 5 years ago. That's a character issue. And that one breaks my heart, because it's like, had you had just put yes, we could have gotten over the hurdle, typically, depending on the length of time from the bankruptcy. But my credit management is really particular about that. They see it as like, that's a flaw in character. The answer is very simple. Have you filed bankruptcy? And people put no, when indeed they have. So, and that kind of gets brought up in the due diligence period, right? And so we find that out kind of while we're kind of like knee deep into it. That's a big one. I mean, this is another big one. We pull credit right when we get the LOI signed, but we do obviously have your buyers fill out a PFS, right? And a lot of times people are pretty lazy and half-assed.
What does that stand for?
Yeah, personal financial statement,
Yeah.
right? So that's going to list all your assets and your liabilities. So we're talking your houses, your cars, your cash, your stocks, and then obviously all the loans that are associated with those assets. And a lot of times people are, like I said, very lazy. And so I'm doing my due diligence when I issue an LOI strictly based off the PFS and all the financials that are being provided to me. And a lot of times at this point, I'm already on the phone with your buyer and I'm asking questions, but Once you have a signed LOI and I get a good faith deposit and we go into underwriting, the first thing we do is pull credit. Now, if you manage to leave off 4 or 5 specific debts off your PFS that equate to maybe $3,000 a month, which is $36,000 a year, that can impact cash flow. Like had I known that, I could have accounted for that on the front end, and 36,000 could be enough to make a deal not work anymore, right? So I think just filling out the PFS accurately or the personal financial statement accurately. So when I'm doing my due diligence and I'm presenting it to my credit team, it's an accurate picture, right? Because we're going to find out anyways. And a lot of times I don't think it's people hiding things. I think it's just them being lazy. They want to get the PFS over and they don't want to put everything. So I think that's one. Now on the seller side, I mean, we have taxes, so that's fine. I think the biggest thing is, and it's not that time of the year, but I think for anybody watching this, this is a big one. We'll be using your P&Ls. Let's say we're using your 2025 year-end P&L. Now we're looking like we're in September. So we're in September of 2026. I'm looking at your 2025 year-end P&L, and I'm basing my deal off of your 23, 24 taxes and your year-end P&L. Well, guess what's about to happen? The deadline for you to have to file your 25 taxes comes up, right? And so let's just say you're already in contract. It's in September, but now October's rolling around. And so let's say we have a close date of October 31st, but you have to file your taxes by October 15th. So when I get those 2025 filed business taxes and they look significantly different than your 25 year-end P&Ls because, you know, maybe you don't want to pay Uncle Sam or whatever the case may be, that is a really good example of how a deal could literally die at the 11th hour, right? Because you're right there. We have to wait till, you know, the last Friday or a Friday to close on a FedEx deal, wait for the stand-up date. But since we got past that October 15th date, we're required to get filed taxes. And so once I get those taxes, they could be vastly different than the year-end P&Ls that I've been looking at. And that is I see it happen every year. So that's something that kills all deals, not just a FedEx deal, but just something to be aware of.
Yeah, and that's heartbreaking, especially after going through everybody's been through, and then you get to the very end. So if a FedEx contractor plans to sell this year or in 12 to 24 months, what would you recommend that they do to get SBA pre-qualified?
Yeah, I mean, I think, listen, me working at the bank, we don't like people having to pay taxes. We get it, right? Like we've seen it all, we've done it all. My advice really is like, let's say you're planning right now, you're a year or 2 years out from selling. I mean, really, you should be getting with your CPA. You know, hopefully you have a good relationship with your CPA. And my advice is trying to minimize your tax liability, but still allowing for what we call, you know, seller's discretionary earnings to add up. So what that really is you're just minimizing the net income, because the net income is what you're essentially paying taxes on. And that's by expensing things, I guess, the legitimate way: depreciation, interest, amortization. Like, how can you maximize your expenses while minimizing your tax liability? But really, the true answer is you just want those 2 years to look the best, right? I mean, sometimes you're going to have to pay some taxes if you want to sell your business for a maximum amount, right? So I think a lot of sellers forget that we're using tax returns, and they could tell us a million things, but at the end of the day, we base everything off of taxes. We're not mad at them because they wanted to write things off and not pay taxes, but at the end of the day, we can only underwrite based off the taxes. So I think it's just getting your books as clean as possible for the next year or two, right? Kind of minimize all those personal expenses that are being built into that, and just kind of know what your target goal is. And when you're filing at the end of each year, just make sure you're going through that with your accountant. Hey, I want to see this certain SDE or this certain cash flow. Let's make sure we have that, you know, obviously doing it on the up and up. And I don't think there's really any other better way to do that.
I'm glad you brought that up. One last question, Jeff. How many years of tax returns do you need from an owner?
Well, I mean, the SBA says to get 3 years, but let's just say they bought it back in, you know, 23. The reality is there is no minimum time in ownership per the SBA. So if they bought the business at the end of 24, right? And so really they had it maybe, I don't know, October of 24, and they just really started operating for a full year in 25. Technically speaking, that's still eligible. Now, if that was the case, we would obviously want them to file their 25 taxes, so we at least have 1 year. But I would say we want at least, I mean, a standard transaction looks good if we have 2-year taxes minimum. So at least 2 full years in operation with filed taxes. Something important for a lot of your viewers to listen to is, I also don't like to create extra work. So let's just say you do have that incident where we have 23, maybe 24 and 25, 23 and 24 are filed. Maybe 23 doesn't look that good, right? We don't have debt service in 23, but we have it in 24, and we also have it in 25, but it's just on a P&L or a year-end financial statement.
Yeah.
Oftentimes, we're going to want to see that 25 to be filed. However, we are willing to go through the due diligence process at the bank, meaning we'll underwrite the deal. based on that P&L. But we're going to have it very clearly laid out in our LOI. So this is not only for the buyer, but this is for the seller. Hey, we're underwriting this deal based on the financial statements that you've provided us for the 25-year end. We will get the loan approved based on those numbers, but we are not going to fund the loan until we have a tax return filed. And what that really does is, listen, what does it mean to the seller at that point? Because now they know they have a lender, assuming that they just have to file their taxes. And literally that could be like the week of closing, right? We're not asking them to go crazy. They'll get an approval from us. And if the 25-year end is really what we need to get the 2 years cash flow, sometimes we will ask for that tax to be filed. And that won't be until we have a commitment letter to the buyer. So that's kind of on a case by case though.
I see. I do have one more question. I lied to you.
Okay.
How long do you think that your bank takes to fund a loan? Because some sellers tell me, well, I can do a cash deal, or I hear other brokers saying, I'm not going to do SBA because it takes 6 months or whatever. How long do you guys take?
I mean, you can ask anybody here. I'm pissed if any deal takes 45 days from the day we issue an LOI. So that's very critical, right? There's a lot of back and forth going into a deal, just collecting docs, right? But I mean, our package is relatively simple. We're going to get 3 years personal taxes, a personal financial statement, and a resume from the buyer. And then on the seller side, 3-year business taxes, year-end P&L or interim P&L and balance sheet, and then a vehicle or equipment list. That's really all I need on any given deal to get an LOI in the door. Once I have a signed LOI, we're looking at 45 days. However, there has not been one FedEx deal that I've ever done in my career where we're waiting on the bank. We're always waiting on FedEx. So there's never, ever, not one time has it even been close where Antoinette or any of my other brokers are like, Jeff, hurry, we need, it's always like, can you guys hurry? Like FedEx is, they're just not that interested in the bank or anything for that matter. They kind of go at their own speed, right? You have the training, you have stand-up dates, you have contract renewals, all these things play into any type of transfer ownership or the FedEx route. And so we always are pushing back close dates based on FedEx. We're always ready to close the deal within 45 days, but at the end of the day, we're at the mercy of the FedEx Corporation. And so, yeah, sorry, that was my long-winded way, but FedEx always holds the deal up.
And I can vouch for that because I know that you guys have been ready to close a deal, but we're waiting for training and FedEx and all of that. Jeff, thanks so much for being on with me. I have a lot of questions and I know my sellers will have questions. So how can someone get in touch with you if they have questions or they want to fund a deal or get SBA qualified?
Listen, I want to say this. I'm so blessed to be as busy as I am. So obviously, my phone, it's always easier to shoot me an email because I just don't want anyone to think that I'm ignoring them, but I'm always on the phone all day. So my name's Jeff Fulcher. So my email is Fulcher is Fulcher, and that's at VelocitySBA.com. And of course, my phone number is 703-606-7192. Again, I don't always pick up because this is what me and you do all day long. We're on the phone. So if I don't pick up, please just shoot me an email. No question is stupid. So happy to answer them. And, I'm always available if anybody needs me.
Thanks, Jeff. Don't forget to hit subscribe. We talk every week about selling businesses, increasing your profit, and setting you up for retirement or your next move.